The capital is in turmoil. Sirens wail through the night as uncertainty grips every corner of the city. Tension hangs in the air, thick and unyielding as citizens brace for what comes next. Protesters flood the streets, furious over austerity and lost jobs. Their voices echo through the avenues, demanding change, desperate for hope. The anger is palpable, fueled by years of broken promises and mounting hardship. Inside the presidential palace, the finance minister negotiates desperately with the IMF as the country's currency collapses and reserves vanish. Every decision is critical, every moment counts, as the nation teeters on the edge of financial ruin. Without an emergency loan, the government will default. No money for workers, medicine, or fuel. Hospitals run out of supplies, public services grind to a halt, and daily life becomes a struggle for survival. This crisis is all too familiar worldwide. From Latin America to Southeast Asia, nations have faced similar turmoil, their people caught in the crossfire of economic collapse. The IMF and World Bank offer a lifeline, but at a steep cost. Their loans come with strict conditions, demanding reforms that can reshape entire economies. Supporters call them global saviors, stabilizing economies and preventing chaos. They point to recoveries, renewed growth, and restored confidence in markets as proof of their positive impact. Critics see them as agents of economic control, imposing harsh conditions that hurt the vulnerable. They argue that austerity measures deepen poverty, leaving families and communities to bear the brunt of recovery. The debate is fierce. Are these institutions rescuers, or do they trap nations in debt and dependency? Lawmakers, experts, and citizens argue passionately, each side convinced of their truth. The answer isn't simple. Their interventions shape the lives of millions, for better or worse. Every policy, every loan ripples through society, affecting futures in ways both seen and unseen. The stakes are high, and the consequences ripple far beyond any one country. What happens here could set a precedent for nations everywhere, influencing global stability for years to come. Tonight's decision will echo for generations. Leaders weigh impossible choices, knowing that history will judge what they do next. The world watches, waiting to see if help will come, or if the price is too high. Every eye is fixed on the unfolding drama, as the fate of a nation hangs in the balance. This is the story of the IMF and World Bank, a story of crisis, hope, and the power to shape destinies on a global scale. To understand the controversy, we need to know what these institutions do. The IMF is the world's emergency lender, stepping in when countries face financial collapse. It provides short-term loans to stabilize economies, but demands policy changes in return. The World Bank, meanwhile, funds long-term development, schools, roads, clean water, aiming to reduce poverty. Both are headquartered in Washington, D.C., and include nearly every country as members. Their decisions can make or break economies, shaping everything from healthcare budgets to currency stability. Created after World War II, they were meant to foster global cooperation and prevent future crises. Today, their power is immense, and so is the scrutiny they face. Their influence is felt in every corner of the globe. The IMF and World Bank were born from crisis, emerging as a response to the economic turmoil and instability that followed the Great Depression and the devastation of World War II. In 1944, as World War II raged on, representatives from 44 nations gathered at Bretton Woods, New Hampshire, determined to design a new global economic order that would prevent future catastrophes and foster international cooperation. The International Monetary Fund, or IMF, was created with a clear mandate: to maintain currency stability, oversee the international monetary system, and prevent the kind of financial chaos that had plagued the world in previous decades. The IMF provided short-term loans to countries facing balance of payments problems, aiming to keep global trade flowing smoothly and to restore confidence in international markets. The World Bank, meanwhile, was originally established to help rebuild war-torn Europe, financing the reconstruction of infrastructure and industry. However, its mission soon expanded to include funding development projects in poorer nations around the world. Over time, the IMF's focus shifted toward promoting macroeconomic stability, helping countries manage their budgets, stabilize exchange rates, and shape effective monetary policy to foster sustainable growth. The World Bank, on the other hand, targeted long-term development projects, building roads, bridges, schools, and hospitals, and supporting improvements in health and education for millions. In times of crisis, countries often turn first to the IMF for immediate stabilization and financial support, and then to the World Bank for the longer-term process of rebuilding and development. While their roles are distinct, the impact of the IMF and World Bank is deeply intertwined, as both institutions work together to promote global economic stability and growth. Together, they became pillars of the post-war global economy, shaping the financial landscape and supporting nations in times of need. Their legacy is still unfolding as they continue to adapt and respond to the world's ever-changing economic challenges. When countries face financial crises, they often turn to the International Monetary Fund, or IMF, for help. But IMF loans come with strings attached. These are known as conditionalities, and they shape the future of borrowing nations. These conditions, often called structural adjustment programs, require countries to make tough choices, cutting government spending, privatizing state-owned industries, and opening up markets to foreign competition. These steps are designed to overhaul economies, but they can be deeply controversial. The IMF argues that these tough measures are necessary to address deep-rooted economic problems and restore long-term stability. They believe that without such reforms, countries risk falling into even deeper crises. Supporters claim the pain is only temporary, and that these reforms pave the way for future growth, increased investment, and a stronger economy in the long run. Critics, however, argue the opposite, that these policies often hit the poor and vulnerable the hardest. They point out that cuts to health and education can leave lasting scars, and that local industries may be exposed to overwhelming competition, sometimes leading to collapse. Privatization, while intended to improve efficiency, can sometimes drive up prices for essentials like water and electricity, making basic services less affordable for ordinary people. Trade liberalization, another common condition, often wipes out small businesses that can't compete with larger international companies, leading to job losses and economic hardship. For many, these conditions feel less like a cure and more like a bitter pill, or even poison, making recovery seem out of reach. The debate over conditionality is at the very heart of the IMF's global reputation, fueling passionate arguments on both sides. Is it tough love that leads to a brighter future? Or a recipe for deeper crisis and inequality? The answer, as always, depends on whom you ask, and on the lived experiences of those affected. Nowhere was the IMF's impact more dramatic than in Latin America during the 1980s. A debt crisis erupted as global interest rates soared and export earnings collapsed. Mexico defaulted, triggering a regional meltdown. The IMF stepped in with bailouts, but demanded harsh austerity and market reforms. Governments slashed social spending, privatized industries, and opened markets. The result: soaring poverty, unemployment, and inequality. The lost decade. Many in Latin America saw their sovereignty eroded, with economic decisions made in Washington, not at home. The scars of this era still fuel mistrust and backlash against IMF policies. The legacy of the lost decade endures. In Africa, the World Bank and IMF funded vital infrastructure: dams, roads, schools. These projects brought real benefits, but also mounting debt. By the 1980s, many African nations faced crisis, forced to accept new loans and harsh adjustment programs. Austerity gutted public health and education. User fees put basic services out of reach for millions. Privatization and market reforms left farmers and workers vulnerable to global shocks. Critics say these policies deepened poverty and dependency. Yet, recent years have seen some change. Debt relief initiatives and new poverty reduction strategies have helped some countries recover. The relationship remains complex, marked by both progress and pain. Africa's story with the IMF and World Bank is still being written. The Asian tigers, South Korea, Thailand, Indonesia, rose through state-led growth, not IMF orthodoxy. In 1997, financial panic swept the region. Currencies crashed, economies teetered. The IMF offered massive bailouts, but demanded sweeping reforms, high interest rates, open markets, and dismantling of state-led models. The result was deep recession, mass unemployment, and political upheaval. Critics, including top economists, argued the IMF's medicine made things worse. The crisis shattered faith in the IMF across Asia. Countries vowed never to be so vulnerable again, building up reserves and creating regional safety nets. The lesson reliance on the IMF comes at a cost. The Asian crisis changed the global financial landscape. It fueled a search for alternatives and a new skepticism toward Western-led solutions. The scars still shape policy today. For decades, the IMF and World Bank dominated global finance, with Western nations holding most of the power. The US and its allies control key decisions, fueling accusations of bias and self-interest. Emerging economies like China and India have demanded more influence, but reforms have been slow. Frustration has led to new alternatives, most notably China's Belt and Road Initiative. Chinese loans offer quick funding with fewer conditions, appealing to many developing nations. But critics warn of debt trap diplomacy, where countries risk losing control of key assets. The rise of alternatives has sparked new competition and forced the IMF and World Bank to adapt. The global financial order is no longer a Western monopoly. The future will be shaped by this new multipolar reality. The rules of the game are changing. The world has changed, and so must the IMF and World Bank. Private capital, rising powers, and past failures challenge their relevance. Calls for reform are urgent: fairer voting, more flexible policies, and real partnership with borrowing nations. The old one-size-fits-all model is discredited. These institutions have both rescued and harmed economies, lifting millions but also deepening poverty and debt. Their legacy is mixed, their future uncertain. The challenge: learn from mistakes, empower nations, and become true partners in development. Are they a helping hand or a hidden trap? The answer is still being written. What do you think?